So we are about to begin our last committee session of the week. It is 10:15. And we're going to talk about corporate tax. We're going to start with like a very brief explainer on corporate tax, and then we're going to hear from someone from the organization called CBPP, and then we are just a center on budget and policy priorities. And then Kirby's going to share some updated language with us that I asked him to draft. And then we will have lunch and catch up on other things. So with that, Kirby, would you like to join us? Or both of you at the same time? Pat? Whatever you want to do up there. Thank you. Sorry, Pat.
Oh, good. So Patrick Tiverton, Joint Fiscal Office. A day or two ago, Kirby and I were comparing notes on what we were planning on presenting and realized that there was a lot of overlap. So what I'm going to do is just sort of talk about the revenues, how they look over time, and that sort of stuff. And so if you have technical legal questions, just know that when Kirby comes up to talk to you, he's probably going to cover a lot of that. But I have some slides that I will share. Again, because of the reflection in my glasses, I can tell it's up on the screen.
You are a superhero.
Wow. Yeah, so I'm just going to cover sort of high level revenue topics with you all. But just to start, just to sort of distinguish what we're talking about here, Vermont treats businesses in kind of two different ways. There's the corporations, which we're going to focus on today. And then there's that, many other different types of businesses that are in the state, including sole proprietorships, partnerships, things like that. So what we're really focusing on today is just those, limited liability incorporated companies that we just refer to as C Corps. So just to delineate between the two. So currently, Vermont has a top marginal rate of 8.5%, and that is on income above 25,000. Nationally, that's a relatively lower top income threshold, but overall, we'll see in a couple slides. It's not like an outlier top marginal rate.
What's our top marginal income rate?
For personal income, 8.75%. For married couples, it's like above, I don't know.
I'm sorry.
So 8.75%. And so that is on corporate income on a unitary group, which was a recent change, which Kirby will talk about a little bit more. But it's on the total net income for the parent corporation and all of its subsidies. So, it's not just you have this subsidy that doesn't really work here. If it's wholly owned by the unitary group, it's going to have to be included on the return. And so you get the whole income for that unitary group, and you have to figure out how much of that income is, taxable in Vermont. Previously, we used a three-factor method, which was based on payroll, property in the state, and your sales. But for tax year 2023, that shifted to a single sales factor. Sort of part of the thinking there is that, if you have a large payroll and property presence, you're going to be supporting Vermont economy in other ways. You have employees who are working, buying things in the state, paying their income taxes. And the shift really is putting more of that tax burden onto corporations that really don't have a big physical footprint here, but they're selling a lot into the state. So that change was moved to a single sales factor. So really it's just all of your sales that come into the state and are attributable to the state. That's what you apply to your total income to establish what your taxable income here is. But we do also have a corporate minimum tax. And a lot of corporations end up paying this. And those are, it's roughly, when we looked at this last year, it was about 70% of these returns had zero or negative taxable income. So they were paying this minimum tax, which ranges from about $100 to $100,000. And so here, just looking at the tax rate schedule, you can see the brackets here. There are two brackets below the top one. And then you can also see here what the minimum tax is. One distinction I'll make here is that, so the top bracket, that's applied to net income or the corporation's profits. If they're showing negative, then you start to look at the gross receipts or total sales that they're making. So that's just, you're comparing two different types of revenue or income that the corporation is having if you're using one schedule or the other. So overall, there are 44 other states that have a corporate income tax. 15 of those, like Vermont, apply different rates. They have those brackets. But the remainder, they just level a single flat tax, regardless of how much income that the corporation is reporting. And there is quite a variance between whether it's three-factor, double-weighted sales, or just single sales factor between the states. But we have seen that there have been more states moving into the single sales factor. And yeah, so 8.5% is the top corporate rate. That starts at 25,000. And just comparing across different states at that specific level of 25,000. California, Delaware, Illinois, Minnesota, Pennsylvania, all those states have a whole higher rate at that particular income amount. So they might have other brackets, obviously, but it's just at that amount. Their rates are higher than Vermont's. And if you want more detail on that, I have a link here from the Tax Foundation that you can go look at every state's brackets and how they apportion and stuff like that. And this is just a map showing you the top corporate rate in each state. I think you'll see it again when Kirby shares his materials, but just think it's interesting if you ever want to think about just seeing how we compare to other states. There's quite a bit of variance in how much, like how they treat it, but you know, generally speaking, this is just showing you the top marginal rate in each state and country. So,
Representative Lee?
Am I right, Patrick, that it's quite possible that of those states that have a higher or the highest multiple, the highest incremental rate that's larger than Vermont, it probably is triggered at a higher net income value as well?
so
Ours kicks in flat at 25,000, but I'm betting that other states have other steps above that to get to the top.
yeah, certainly. So, I mean,
Okay.
if we just come back to the slide briefly, these are the states that had a higher rate at that particular threshold.
Right.
It's not saying that's where their threshold kicks in. It's just at that income level. That was what the rate was. But yeah, you'll see here, Iowa wasn't on that list of states I just showed, but they have a 12% top rate, meaning that it's kicking in at a higher level than what I was looking at on the previous slide. Yeah. So I know you all had a chance to listen to Tom and Jeff yesterday, but just to sort of reiterate a couple of points from the forecast, they're estimating about $241.5 million in revenue from this source in fiscal year 24. And just looking at general fund revenue in its totality, that's about, you know, it's a little less than 12% of total general fund revenues. You know, in a slide or two, we'll see how that sort of percentage has changed over time. But that's a pretty big chunk of, you know, what's coming into the general fund. I know they presented it as a very sort of positive forecast. So there was a downgrade technically, but they were describing that as sort of technical adjustment, not sort of like any difference in their opinion on what they view going on in the economy. So $1.2 million downgrade from the July forecast, which is 0.5%. So, and overall, and again, you'll see how this has changed over time, but last year we collected $281 million in corporate income revenue. And so this year, just based on new economy conditions, that's, you know, down about $40 million from what we saw in the last fiscal year. So it's still a significant portion of the general fund, but just note we're at a sort of lower base level here than what we were talking about last year. So overall, that's about 14.2% lower than what we received last year, what they're projecting. So just to talk about what's gone on in the first 6 months, from July through December, we collected about $7.7 million lower than what the forecast had estimated. It's about 7.3%. But you'll see, even with that, sort of, we'll call it a miss in the first 6 months, they're still only downgrading total year revenue projections by 1.2 million. So my kind of read on that is they're anticipating us making up a little bit of that ground in the second 6 months that we potentially lost in the first 6 months. And yeah, just to reiterate, we're at a lower base level this year compared to last year, 280 versus 240. And that, from their narrative just really comes as they expect corporations in the economy to sort of, and they said the similar things about personal income, to face some headwinds in the economy going forward. Like, they had a whole laundry list of reasons for that in their report, which I see some of you have in front of you. Yeah, after that initial decrease that they're projecting in the first couple of years, going forward, they are sort of projecting that we'll start to see sort of steady increases going forward. So again, they kind of reiterated the point, soft landing, right? So I think
Describe it as rebasing higher than pre-pandemic, but I think it's the exact same thing.
there's a lot of
Fun jargon.
Yeah. Good at that. But yeah, overall, based on their forecast, continuing to see probably about 11% composition of corporate income revenue within the general fund. So still a healthy chunk, right?
That's one thing that they keep on bringing up is how much the mix has diversified compared to compared to 5 years ago, and how excited they are by that. Just like how many more payers there were than there used to be.
I don't have the number of payers in front of me. I know last year, if you remember, we were looking at an alternative funding package for the childcare bill. We looked at how many payers are where they are on the scale. So I have the single year look, but if you're interested, we could look at over time, and maybe Tom already has that on a table somewhere that I don't.
Yeah, we can find it some other
Yeah.
time. So that was sort of an interesting piece of.
So yeah, this is just the chart that I prepared. There's this box in the way that I can't see. Just showing you how corporate income tax collections in the state have changed over time. Generally from about 2006 to, what was that, 2021, 6.8 to 7.5% of general fund revenue. There's some ups and downs here and there, but we don't really see any sort of ginormous swings in the amount of corporate tax that is being collected. Although I will note that this chart is a little bit more lumpy or volatile than you would see in something like the personal income tax collections. But what's really remarkable is once the pandemic hits, that's a huge spike in what the state was collecting in corporate income. So really the last couple of years are really sort of outliers in the trend. So while they did it sort of iterate that point that, we're at a lower level, sort of rebasing from where we had been the last couple of years, we're still, I said that we're expecting 11.3% of general fund revenue to be coming from corporate. That's still well above previous year trends.
Yeah, I don't remember the specifics. But over the last couple of years, when we were downstairs, we tinkered with a lot of corporate income tax things, changing from Finnegan.
We went from Joyce to Finnegan.
But Joyce to Finnegan, single sales, da, 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 da. One of our objects was to get more businesses to locate here. And how's that going, I guess? Really, Dell.
Well, so 2023 was the very first tax year when that change was implemented, and we don't have finalized numbers for that yet, but
Pretty good answer.
that's certainly something that would be on a longer time horizon than, maybe a year or two. But it's something we could look at over, the next 10-year time horizon.
That would be helpful.
Okay.
Yes.
Thank you. This is fascinating for what it says. What I'm I was trying to look in Cavet's report to track the Vermont GDP for the similar period. And the reason I'm curious about that is whether or not corporate collections have actually grown with the economy, which is a different question than the proportion of general fund revenues. Understanding that, of course, because we changed the reporting scheme to unitary a few years ago, it really apples and oranges when you go back, say, 10 or 20 years. But I haven't found a GDP for Vermont figure to actually make the calculation. You have a sense whether the collections in relation to the growth of the state economy have grown also, or just stayed essentially flat?
So I don't know the answer specifically, but one thing that's really interesting when you look at this chart is during those pandemic years, you actually did see a slowing and in some cases even shrinking of GDP, right? But that was sort of met with everybody's got a lot of cash in their pockets, so they can go buy a lot of stuff, which helps the corporation's bottom line. And with that, a lot of them were sending employees to work remotely, not in the office. So presumably, and this is sort of anecdotally me thinking through this, they probably had lower overhead that they were having to spend. So, the few competing factors, really key in that is just people had a lot of cash in their pockets and were spending it. Really in those couple of years sort of drove it up in a sort of counter-cyclical fashion compared to what GDP was showing. But I haven't compared closely enough the trends in the preceding years to have a firm answer to that question. So the next slide here related to the first one is just showing the percent change in corporate income revenue year over year. I don't have it labeled here, but Joyce would be very upset if I didn't mention that this is not adjusted for inflation.
We would all be really upset.
Well, her especially, and she's much closer to me physically. So, really, I think what this just sort of illustrates is that in percent terms, comparing year over year, some years it goes up, some years it goes down, some years it goes up, some years it goes down. There are some large spikes here, but generally speaking, I'm just showing sort of the relatively volatile nature of this type of income tax compared to, something like personal income. I just thought it was interesting to look at. But similarly, sort of expanding our universe here, I want to just look at what corporate profits and taxes have looked like on a federal level. And you can see, again, kind of similar to Vermont, sort of, plodding along, increase, steady sort of consistency for a long time. And then again, you see that big spike once we hit COVID. So it wasn't something specific to corporations' experience with Vermont. It's something that, sort of nationally, a lot of, we saw consistently across the economy. And the scale kind of contorts this table a little bit. Just look at the left side here. We've sort of rebased. But, generally, from about, when are we starting here? Like 2012 through up until around the time that the Tax Cut and Jobs Act was enacted. Sort of, general sort of steadiness here in terms of corporate income taxes on the federal level. Then you did see that dip. Presumably, a lot of that had to do with that reform. But, again, just like we saw in Vermont, huge increases in corporate income tax revenue once COVID hit. So again, just to reiterate, it's not like a Vermont specific experience that we're talking about here. It's something that, we've seen on a much larger scale. And I'm almost done, and we can turn over to Kirby to go into more detail on this. But as Rep. Maslin was talking about, these are the 5 changes that you all made a couple of years ago that just went into effect for tax year 23. We talked a little bit about the single sales factor, but Kirby will talk to you more about the 80-20 language and what that means in terms of unitary consolidated filing. I think I have that term right. And just about the Joyce Finnegan methodology, which also was sort of a in tandem change that really works sort of in an interconnected way with some of those other changes that were being made. And that minimum corporate tax schedule that you saw earlier was also something that came out of that reform. Oops, wrong direction. So yeah, this is just to show you what our office had estimated the sort of combined effect of all of those changes were a couple of years ago. Generally speaking, sort of expected to be revenue neutral. I think sort of one of the big pushes, which to your point earlier was we want to try not to penalize companies that have a big physical footprint here. They're paying property taxes, they have the payroll and workers who are paying their taxes, and rather sort of maybe shift that a little bit onto those companies that have very small physical footprint here, but they're selling into here a lot. So I have a link here to that fiscal note about all those corporate changes if you want to dig a little bit deeper. But again, as I said, in comparing our notes, I think Kirby's going to cover a lot of the technical pieces of this. So if there aren't any questions about the revenues, I might be ready to hand off here.
And away, thank you.
Okay.
Good morning, everyone.
Morning.
Eaton, legislative council. I'm going to share a presentation with you that goes over the pieces of Vermont's corporate income tax.
You've done it.
Making some progress with technology. Little, don't get too high of expectations. So I used a presentation from last year that Abby Shepherd had prepared just to give Abby credit and modified a little bit to focus on a couple of areas that we'll be talking about later, which are unitary returns and allocation and apportionment for corporate income tax.
And if folks want more of a 101, maybe if they're watching the studio audience, on the landing page of our website is a 101 presentation on corporate taxes.
And yeah, we'll be going through some of the 101 stuff here. Speaking of, on this slide, you'll see that the tax base for corporate income tax for Vermont is Vermont net income, which is defined in the subsection there, subdivision that's this side of there. Vermont uses tax brackets, marginal tax rates. It also has a minimum tax based on Vermont gross receipts, which Pat had talked about a little bit a minute ago. And then to figure out the tax liability of a corporation or a group of corporations, Vermont uses allocation and apportionment based on where the income is sourced to, whether it's Vermont or outside Vermont. So under the current law, who pays? It's U.S. resident C corporations. So individuals and pass-through businesses do not pay corporate income tax. For U.S. resident C corporations, it's incorporated entities in a name like Inc. or Corp. These C Corps are created, they create a separate legal person, which provides shareholders protection from personal liability. C Corporation refers to the subchapter of the Internal Revenue Code. Corporate income tax is imposed on the entity, not on individual shareholders. And we'll get into shareholders in a minute. Shareholders, of course, pay personal income tax on the dividends and capital gains received for their shares. And the advantage here is the ability to raise money on public markets. So under current law, who does not pay? As we just said, individuals, pass-through businesses, and foreign entities do not pay corporate income tax. There is, for controlled foreign corporations, so I think that some words are switched around there on the slide. For controlled foreign corporations, which are corporations that are owned at least 50% by a U.S. entity, there's some taxation that flows through to Vermont, such as dividends that are paid to U.S. corporations, and something that's called global intangible low tax income, which represents income from intellectual property that's held by a foreign corporation that then is passed on to a U.S. corporation. Some federal taxation of those things does flow through to Vermont as it is, but that's the only way that we're taxing any kind of income from foreign corporations. Business structures like partnerships, LLCs, as corporations, sole proprietors, they do not pay corporate income tax. And income tax is generally not imposed on pass-throughs like those we just said. So for Vermont, net income, which is the tax base, starts with federal taxable income, and then it has plus and minus certain items of income. There's no deductions allowed for bonus depreciation, non-Vermont bond interest, or federal operating losses. There are deductions allowed for certain income added at the federal level related to foreign credits and job creating credits. And cannabis establishments may deduct business expense in Vermont, which they're not allowed to do at the federal level. For more definitions for federal taxable income is a corporation's receipts minus allowable deductions, including cost of goods sold, wages, and other employee compensation expenses, interest, non-federal taxes, depreciation, and advertising. And we have the slide that Pat just shared a moment ago about marginal rates across the country. We don't need to dwell on that, I don't think. We saw some of it. And Pat also mentioned the minimum tax, which there's not a lot to explain there either. Or there's tax based on gross receipts for corporations that have a loss or don't have a lot of Vermont income. There's at least a minimum amount of income tax that's paid. And identifying corporate income. What is the income of the taxpayer? So there's two types of reporting that are possible. It's unitary combined reporting or separate reporting. And then, of course, how do we figure out what income is taxable for Vermont, or in other words, what's a portion to Vermont to be taxed? Some slides coming up about this. So identifying corporate income, most multi-state corporations, as I think you know, have complex organizational structures where there's a parent company and subsidiary companies, and Pat mentioned some of that. There's the two approaches that we just mentioned. There's separate or combined reporting for how those C Corps are going to report their income for taxation. So under separate reporting, that would mean that each affiliated company would be treated as though they were unrelated entities, so that each entity would file its own return. And so separate reporting ignores the relationships between a group of companies that operate together. With combined reporting, the affiliated companies are instead part of a unitary group, and they're treated as one entity for tax purposes. So that entire group files one return as if it were one corporation. I think you know that Vermont requires it has mandatory unitary combined reporting. So under Vermont law, a unitary business is one or more related business organizations engaged in business, both within and outside the state. Under current law, of course, the unitary business is all domestic corporations. They're all going to be just the U.S. corporations that share ownership in an affiliated group.
So anything included in an affiliated group would need to be also domestic under the current law?
Yes, it's all what's part of that for domestic corporations. And that goes to water edge reporting, which we'll get to in a minute. So an affiliated group.
Sorry, Representative
Can you
Energy.
give an example of some of these companies so that I have something I can?
Sure. Vermont example would be Unilever owns Ben and Jerry's. And so Ben and Jerry's would be a subsidiary company of Unilever.
Okay.
Uh, But, and then, of course, Unilever owns a lot of other food companies, and so they would all be part of the same unitary group.
So that, so is that an affiliated group?
Yes.
Okay.
Um,
And it could be a group. So if we were in New Hampshire, Ben and Jerry's would still work as an example because Ben and Jerry's sells sells ice cream here. And soap.
yeah, so my example involved.
I mean, not Ben and Jerry's, so Unilever sells soap, Ben and Jerry's. Sorry. Excuse me. Ben and Jerry's does not sell soap to the best of my knowledge. Sorry to create terrible rumors.
But there could be there could be an affiliated group that's subject to taxation in Vermont because Vermont's a market for that group. And so it's not just things like Ben and Jerry that are based here.
Okay.
Which I think is the point there.
Thank you. That was my attempt at it. Thank you.
So.
Yeah.
Can I ask a question?
Mhm.
Jen? So how does that work on their tax return? Each of these companies file separately and it gets stapled together as one group, or how does that work?
They have to file one return together when they're part of a unitary group.
So they add all their income, all their losses, everything gets added together and one figure's added in?
And
How many accountants does that take?
a lot.
Yeah.
Yes, all of that. And I had a thought, but I lost it. So we'll just move on.
Can't understand you.
I said I had a thought, but I lost it. So it'll probably come up again.
Yeah, okay.
So for unitary combined reporting, like we were just saying, it applies to multi-state businesses that are part of a unitary group. And the portion of the unitary business that occurs both within and outside. This is as of 2023 and involves some of the changes that were made, the US borders. But to clarify, Vermont is still a water's edge where we're looking at US corporations.
Still what?
Part of the group. It's still considered water's edge reporting, which means we only look at the domestic borders of the US for where these corporations are incorporated.
The Hawaii counts.
They have a lot of waters.
They do.
Sorry, I didn't mean to confuse the issues.
And just to be clear,
For 1 second, so now that I get the water's edge part, what did you say? What is Vermont? Is what? We are water's edge.
so for this slide, it says that the unitary combined reporting applies to multi-state businesses that are part of a unitary group and the portion of the unitary business that occurs both within and outside of US borders. I just didn't want there to be confusion to think that Vermont is already requiring worldwide reporting of all of the income because it's not. We require reporting based on US incorporated corporations only that are part of a group. So to also be clear, unitary combined reporting does not apply to S corporations or captive insurance companies under Vermont law. Those are different entities that are excluded. So like we mentioned, Vermont requires combined reporting, and this is a map showing the other states that do. There are 28 states that require combined reporting, so Vermont's in the majority as far as how states require this. It's generally considered a better practice to require combined reporting, to treat a group of companies that are related as one company instead of allowing the separate reporting, which could allow moving around of assets for tax avoidance purposes. There's a lot more loopholes involved when separate reporting is allowed. But you can see that some states do not require combined reporting as of now. And that gets us into the allocation and apportionment. So once we know what the tax base is and what corporations are supposed to file with us. How do we take income that's received, that's sourced to another place, like another state, and then allocate that to Vermont and then not tax the part that would be allocated to another state. So we have a statute, section 5833, and we have a lot of regulations on this as well. So in Vermont, multi-state corporations typically have different member entities that operate in and receive income from different jurisdictions, like I was just saying. And when a C Corp's income is derived entirely from within Vermont, there's no need for allocation because all of the income would be Vermont income, right? But it becomes much more complicated quickly when you're talking about much larger entities and groups of corporations where they have income that's derived from both within and outside Vermont. So that's when our apportionment and allocation statute comes in. Historically, Vermont has looked at different factors to apportion income. It's looked at property, payroll, and sales. One of the changes recently was that Vermont only looks at the sales factor. And we'll get into what that means in a second. Historically, there were states that counted sales factor twice or put more weight into the sales factor. But then when Vermont enacted unitary combined reporting in 2004, it changed its apportionment factors to weigh payroll, property, and sales equally. But more recently, states have moved, including Vermont, toward having what's called single sales factor, where that's the only factor that's considered for apportioning net income. What that means in a nutshell is that we are just, as far as apportioning income, we're looking at how much Vermont is a market for that corporation or that group of corporations, as opposed to looking at the employees and the property and things like that they have in the state. So when Vermont made that switch, it was more favorable to companies that have a lot of presence in Vermont physically, and less favorable to companies that are using Vermont as a market, but not having Vermont, not having their business be present for employment and property. Here's a chart of the states that have sales factor or 3-factor. As you can see, many states use sales factor like Vermont does. And another recent change we made, and this was mentioned when Pat was up here, the move from Joyce to Finnegan to determine state jurisdiction. Under Joyce, which is what Vermont had done before, to consider a corporation to have nexus in Vermont, it looked at that corporation separately from the unitary group and determined whether the entity had nexus by itself. So under Finnegan, which is what we do now, a taxpayer includes all members of a unitary group if that taxpayer has presence in Vermont or has nexus with Vermont.
So backing up to page 19. A 3-factor?
We don't use that anymore.
Oh, okay. Do I need to stress over this page then?
No, because we are on single factor now. We changed it last biennium.
Okay, good. Thank you. Hold on.
We're just respecting history.
Okay.
Can you go back to that?
Thank you, Matt.
Sure. Person done that?
Kirby, could you just give us an example of maybe a real life example of the bottom part of that slide? Or an entity that has nexus and how the other pieces would fit in. If one comes to mind.
Well, we mentioned Ben and Jerry's earlier, which would have some presence in Vermont, would clearly have nexus. So the other corporations that are part of that group would then also have to file a return along with it.
So all the other corporations that are part of Unilever, the parent company?
Mhm.
Yeah.
But there's apportionment, to be clear. It's not that just by bringing that in and requiring return to be filed doesn't mean that Vermont's taxing income that's sourced to a different place. It will be apportioned out.
Yes.
The other
entities in the unitary group, if they're not in Vermont, they don't have the nexus that Ben Jerry's has it, but they are selling products in Vermont, then that is included in the calculation of Vermont's share of the income. Okay. Okay.
This is a slide showing some more of the history. I don't need to go into it, but this is just some of the effects of the Tax Cuts and Jobs Act, going back to 2017 and 2018. And the last slide I have, just as a primer for you, is this is I think Pat showed the same thing. These were the recent changes that are beginning for 2023. Single sales factor, like we've already talked about, Finnegan, like we've talked about, the 80-20 rule it excluded overseas corporations from apportionment factors. So it changed how Vermont approaches overseas corporations. We repealed what was called the throwback rule. So Vermont is no longer adding back income from corporations in a unitary group that was not taxable in another state, kind of left over. Recently, Vermont also established new minimum tax brackets in the amount. And that's what I have for the primer for you.
Thank you. So we're going to hear from a couple of witnesses sort of talking about the big picture thinking around this. And then essentially like almost the exact same time that we passed those corporate changes last biennium, the multi-state commission that creates model laws came out with a model law for what essentially we had passed. And so after these next witnesses, we're going to look at that language and then talk about a potential change as well as potential expansion. And again, like this is not the only conversation. Sometimes some questions will be unresolved. That's okay. We have time to figure this out. So with that, Mr. Griswold, hello.
Hello.
Welcome to Ways and
Thank
Means.
you. Well, thanks very much. I'm Don Griswold, and Chairman Kornheiser and Vice Chair Canfield, the rest of the committee. I'm delighted to be here with you. State corporate tax avoidance was my career for 3 decades. I was executive tax counsel at Berkshire Hathaway in Omaha. I led a Big Four accounting firm's 600-person practice we called state tax minimization. I was an adjunct professor at Georgetown University Law Center, and there I taught my students that despite Vermont's leadership years ago in adopting combined reporting that Kirby and Patrick have discussed with you, still corporate income tax avoidance in the Green Mountain State is perfectly legal for the rich and powerful. And I tell you, for a planner and avoider, it's easier than shooting fish in a barrel. Today, I'm a senior fellow at the Nonpartisan Center on Budget and Policy Priorities, and I analyze the implications for states of corporate tax avoidance and the responses to them. And I'm particularly concerned with the issue of discrimination. Right now in Vermont, it's virtually optional for a sophisticated multinational to pay your corporate income tax. But all your in-state small businesses, they have to pay full freight. The solution, as Patrick and Kirby have hinted at in their presentations, is worldwide combined reporting. Now, based on this discussion, I understand you guys have a pretty good handle on these issues. I'd like to go through them in 3 parts. First, the problem. Second, Vermont's historical response to the problem, digging a little deeper than Patrick and Kirby did. And third, the solution and how it works. Now, I'm going to go through at a higher level written comments that I gave you, but if you do have that presentation, the bottom of page 1, you'll see a simple snapshot of your 3 policy options for reporting purposes. And I'm going to explain these as we go along. So if you just sort of keep an eye on those, I'll return to those 3 similar charts there as we go. But let's talk about the problem. It's common knowledge that powerful multinationals avoid hundreds of billions of dollars in federal and state income tax. They pay huge fees to sophisticated advisors like former me to develop really an endless variety of complex schemes for profit shifting. And the problem is this profit shifting, where you take your profits, and remember, profits is the tax base. You shift your profits outside of Vermont, beyond the reach of Vermont, into tax havens. And these are tax havens, whether they're US domestic or whether they're foreign, they're basically cannibalizing Vermont's tax base by setting up as tax havens. So take a look at those three diagrams. Each of them has an identical profit shifting scheme. Your little box at the top is the parent corporation there that Kirby and Patrick have discussed, and below are two of the hundreds of subsidiaries they're going to have. Let's say here that in each of those three little diagrams, the little sub box on the lower left is in a domestic tax haven, say Delaware.
I'm sorry, 1 second.
I don't have the boxes and the things he's referring to. Can you tell me where they are again?
First page of his,
First page of Griswold testimony.
Testimony, yes. Give folks 1 second, sorry.
Of course.
Oh, okay, I got it.
Okay, great. All right,
Box is
so
up.
we good?
Yes.
Thank you.
Okay, good. So the three diagrams show the same thing. So just take a look at the left. They're all the same in each one. That top box is the parent corporation who owns and controls, directs everything that's going on for this huge multinational business. And then two of its hundreds of subs are shown below. The one on the left, let's say that's a US state. Delaware is a prime example of a tax haven in the US. And let's say the one on the right is a foreign tax haven. Pick your poison, call it Cayman Islands, say. The arrows represent profit shifting. That is, so on the left, let's say that the parent moved some trademarks down to the Delaware corporation. That arrow represents the royalty that the parent pays to the sub. That royalty is deductible. It drains, maybe even zeroes out your tax base in Vermont for the parent and sends it down to that tax haven. Just the foreign side of that, the offshore profit shifting on the other side. Maybe they migrated patents over to the Cayman Islands there, and they're going to pay a royalty for that as well. So you're zeroing out or dramatically reducing your tax base in the only company that actually has a specific presence in Vermont. Now, and these three examples, we're going to walk through how the state can respond to that. But before we do that, I want to share with you a handful of facts that I found quite sobering. And when I share these with you, I want you to remember the piggybacking effect that Kirby mentioned. And that is because Vermont's tax calculation starts with the federal profit number and the federal tax calculation, every bit of profit shifting and tax avoidance that is done for federal purposes, Vermont gets its apportioned slice of that avoidance. That is, Vermont loses its apportioned slice of that revenues. When federal tax avoidance happens, Vermont automatically piggybacks on it. So here's some information about the whole big picture. Multinationals with US parents, the federal government lost $60 to $94 billion in 2017 alone to offshore profit shifting by multinationals with parents that are in the US. So that means that number doesn't include household names in Vermont, businesses that we all know that have foreign parents, these multinationals. Companies like Subaru, Nestle, T-Mobile, it's German owned, who knew? A second fact, and let's stick with the companies that are household names in Vermont. 6 taxpayers: Apple, Cisco, eBay, Facebook, Google, and Microsoft. Over the period 2009 to 2022, together those 6 companies alone underpaid their US corporate income taxes by $277 billion. They did it by skirting rules that were supposed to reduce the impact of that cost, that offshoring. Add penalties and interest that they owe on this, that's $500 billion. Now remember, Vermont piggybacks on that federal avoidance. A third fact, let's go back to Ben & Jerry's and Unilever, its owner that was mentioned there. Unilever claims that it doesn't use tax havens for tax avoidance, but it admits on its website that it has subsidiaries in 2 notorious tax havens, Jersey and the Isle of Man. Don't know what that means, but we might be able to guess. Another fact, tax havens in your org charts. As an avoider, I always poked around in the organization chart showing all the legal entities. And let's pick a handful of, again, household names in Vermont that set up shop in Vermont, that sell to Vermont customers, that benefit from local police and fire protection. Walmart, Exxon, CVS, all have subsidiaries in notorious tax havens. I'll give you one last statistic. This one really blows my mind. Again, looking at the foreign profit of US-based multinationals, 50%, half of the foreign profits that these US-based multinationals report as being taxable overseas, half of it is in just 9 tax havens. This is the state of play. This is the problem. It is absolutely massive. Now, so a few years back, the Institute on Taxation and Economic Policy, ITEP, they did a multi-year data analysis, and they estimated that in 2018, Vermont would have collected an additional $31 million if it had adopted worldwide combined reporting, which closes this offshore profit shifting loophole. The number nationwide was $17 billion. Now, I tell you, these numbers are due for an update, but we're hoping that they're going to generate the new calculations sometime this year. Now, I want to pause for a minute before we go on to part 2, how Vermont has responded to this problem, and just reflect that this problem of unfettered profit shifting, it's not limited. The problem is not limited just to the reduction in public funds that go to projects to improve the public good, that go to building an inclusive prosperity. What does it do when the people see legislatures leaving pervasive tax avoidance unchecked, when they see a system that looks pretty rigged in favor of these multinationals over their own Vermont businesses? That can undermine fiscal citizenship. It can sap confidence in government for the common good. I think the issue is much bigger here than just the very important money. Okay, let's move to part 2 then here, and that's Vermont's incomplete historical response, and which leaves the problem unsolved. So we're going to take a look here now at our pictures down at the bottom of the first page. So up until 2006, Vermont looked like the picture on the left, separate filing, which for those states, and almost half the states still have that, I call them voluntary victim states, who just say, make the tax optional for us, please just do it. The gray shaded area there, if you can see that on your screen, shows that just the parent company is subject to Vermont's tax calculation. That's it. So those arrows that show the royalties paid to the Delaware tax haven and to the Cayman Islands tax haven, they just suck away the tax base. That profit shifting works completely. You're a voluntary victim state. You were a voluntary victim state up until 2006. Then 2006, Vermont really led the way. For the first time, I think it was something like 2 decades, Vermont was the first state to wake up and say, hey, let's try to plug this loophole. And you did that with the middle picture, which I've labeled domestic, and it has been properly described by Kirby and Patrick as water's edge. Why? Because it's going to treat the parent company and that Delaware subsidiary in gray there, as if it's a single legal entity, operating as a single legal entity, as was discussed before. Your income all get and losses all get put together. You come up with a single income number. You look at the sales for both of the companies and the percentage that's Vermont. That's your slice of the pie, the tax-based pie. That's your apportioned share. And so that's great. It knocks out the domestic profit shifting. But you see that white space there with the offshore profit sharing arrow going down to the Cayman Islands tax haven, and you see it's still wide open. It's still wide open. And all I do as a planner, I just stop doing domestic profit shifting and I start doing more offshore profit shifting. And I'm still sucking tax base out of Vermont. That's the second piece. Now let's move to that third piece, and that's the proposal. I understand that you're beginning to get your arms around and considering whether you want to go worldwide. Worldwide, you see the gray shaded area, it says wait. Every single company in a multinational corporation, they're all integrated, they're all unitary is the technical term of art. Everything that company does is aimed at what? Improving shareholder value. That's what they're doing. So no matter what they're doing, where they're doing it, what legal entity they put in it, what transactions they create between them, and those are all manipulable things, legal entities and transactions. Those are the building blocks of a tax avoidance planner. Whatever you do with that, you're still going for the same thing. You're a single company. Let's tax you like economic reality. You're a single entity for all business purposes. Let's make you a single entity for tax purposes as well. That's what Worldwide does. It's complete reporting. It gets the picture on the income side of all the income, what's your profits globally, what's your entity's real profits, and then it applies that apportionment fraction that Kirby mentioned. Vermont doesn't get to tax the whole thing. It gets its fair share, its slice of the tax-based pie by looking at what sales are made into Vermont. That's the numerator of your fraction. The denominator is sales everywhere. That fraction is what a portion piece Vermont gets to tax. So when you do that, you're getting a fair system. I should have mentioned too, the U.S. Supreme Court, as tax avoidance community goes after this stuff, they've challenged in the U.S. Supreme Court twice the validity of this worldwide combined reporting method. Twice the Supreme Court has said perfectly legal and it's fair as well. And I'll add, it comports with economic reality. So I sort of stepping back, sort of another way that I kind of like to think of this is worldwide combined reporting makes profit shifting as meaningless as taking my wallet out of my left pocket and moving it into my right pocket. Worldwide combined reporting taxes the whole pair of pants. I don't care where you shift that wallet from cash. The reality is I have it whatever pocket I put it in. So that's my advice to you about how it works. It's going to eradicate, I should say this, it's very important, and it was alluded to earlier, I think, by Kirby. If you draft the worldwide combined reporting statute properly, because you can always have help from the corporate community who can build in secret escape hatches and loopholes. Draft it properly, and you're going to eradicate Vermont corporate income tax avoidance, and I think you're going to improve public confidence in the tax system as well. And I'm happy to either now or after the other testimony, happy to answer questions.
Representative Beck, Odie, Taylor.
Hey, Don, thank you for the testimony. Have any other states adopted worldwide combined reporting?
There were about a dozen states back in the early 80s, actually dating back, I guess the first one was way back by California in the early years of the last century. But it became very popular in the early 80s, especially when the Supreme Court said it's totally fine. So we had about a dozen states. Vermont was not among them. And then at that time, the UK-based multinationals pressured the Margaret Thatcher administration to say, hey, you got to defend our tax avoidance. Thatcher pressured then President Reagan. President Reagan put pressure on the industry, and everybody backed off. Most backed off to water's edge. It was completely baseless, Supreme Court said so, but it was just a brazen act of political power by a tax avoidance industry that was then in the ascendancy. I will say now, when you look at what is happening globally with the OECD, Organization for Economic Cooperation and Development, and the United Nations, both very much going after global tax avoidance. Very different world today. You'd never have that kind of political pressure being able to be brought, but it was brought. And so all these states for all these years have settled back and basically allowed themselves just to have water's edge. A few states like Vermont jumped in, and that number has grown. My colleague Michael Mazeroff has really helped explain to folks why that was an important first step. But no, the short answer is right now there's need for leadership, just as Vermont demonstrated leadership back in 2006, taking the step towards water's edge. There's a need now for leadership. And we're sensing some good movement in a number of states. So we expect this year and next to be a time when states are finally going to wake up and realize they got to stop that avoidance.
Thank you.
Representative Taylor?
How does this fit in with the piggybacking?
Yeah. So think of it this way. Vermont, like virtually all states, says we don't need to reinvent the wheel. The federal tax return of a corporation gives you some basic numbers, and we then piggyback on that calculation. When you go to worldwide, the feds are trying some ways to begin to shut down this avoidance. GILTI, which you conform to, was mentioned. Global Intangible Low Tax Income, cleverly named GILTI, is an attempt. There are other attempts to do it. The federal numbers will have to be translated. The foreign numbers, your income and your apportionment factors, will have to be brought in as well. So that'll be added to that number. And if I could just for a moment, in talking about the worldwide, I forgot to mention that Alaska does today require worldwide. They stayed that way. The reason is their oil and gas industry actually there benefits from worldwide, so they pressured them to do it. And in a number of states, worldwide remains an option. So what they've done is worldwide is the standard statute in, I don't know, maybe a dozen states. And then they allow a water's edge election out of it. And most companies are going to say, hey, I elect water's edge and I get to keep on tax avoiding. So they do that. But there are a handful of taxpayers in these states who do some worldwide. So we've got state experience auditing worldwide returns and so forth. And that knowledge base is out there across the nation.
Representative Odie?
I have my questions.
Okay. Representative Anthony?
Thank you. This is an excellent presentation. I'm a bit nervous when you use the phrase, the feds have been moving towards worldwide. I want to be sure that you're not talking about the IRS by rule, which would be subject to challenge as not authorized by Congress. So, and I don't recall any attempt at tax, pardon the phrase, reform by this Congress. So I'm a little nervous about whether or not the movement that you referred to, the feds, is already insulated from challenge.
That's an excellent point, and thank you for that. The U.S. itself is behind in the game for some of the reasons that you mentioned. We've not been leaders in the fight against tax avoidance, and in fact, in a number of areas, the U.S. federal system can shelter, if you can believe it, can act as a tax haven for others in other countries. But there's a growing sense in many members of Congress, and certainly the administration, Treasury Secretary Yellen, that tax avoidance is a massive problem for the U.S. economy. And so there's a lot of conversation with the leaders, and the leaders are mainly in the European Union right now, beginning to take this on. So I will say that we have two ships moving around the same time. The international ship of of clamping down on tax avoidance is a slow build. A big piece for the federal, though, is that GILTI that we mentioned. That is an attempt to go sort of halfway towards shutting it down. It basically adds back to your tax base a large chunk, not enough, but a large chunk of this tax avoidance. And so the states don't, however, have to wait. Piggybacking has its limits. And when you piggyback on a system that has a massive loophole in it, it's worth considering whether the states want to say, all right, we won't piggyback as to that piece of it. Thank you very much.
Thank you, Don. We have one more question from Representative Beck, and then we're going to move on to our next witness, but would love to have you back. So Representative Beck.
Don, let's say hypothetically Vermont did decide to go to worldwide. Would that move, would it incentivize or disincentivize a corporation from moving its headquarters or its operation to Vermont?
No impact whatsoever.
Okay.
And that is largely because last year you put in place that single sales factor apportionment method that Kirby and Patrick mentioned. It used to be when you divided up your slice of the pie, determined Vermont's slice, a portion slice of the pie, and you did it based upon 3 factors: what your share of global property is in the state, what your share of global payroll is in the state, and your share of global sales, then there's at least some factor involved there as to whether you might want to move. My clients, my clients are basically the Fortune 100. They never moved because of that, but theoretically they could have. Now with just sales, the only way they could say, oh, we don't like your worldwide, so we're moving out. Moving out now means we're going to stop selling to you. Walmart's not going to sell to Vermonters. Apple's not going to sell to you, and so forth.
Oh, yeah.
That's the only way they can do it, and they're not going to do that.
Okay, thank you. I appreciate that.
Thank you so much for your time today. I really appreciate it, and do hope you can join us again. This has been really helpful, especially your diagram. Thank you.
I'd be delighted to. Thank you.
Mr. Appel, will you help first? Please join us and also tell me how to pronounce your name.
Thank you. It's Opal, like the stone.
Welcome. Thanks for joining us.
Yeah, well, and you know, somewhere along the line, my ancestors added the P, but decided to go with the different pronunciation. So, as an English major, I'm slightly embarrassed, but it's what my family handed me. First of all, Madam Chair and members, thank you for the opportunity to appear as a neighbor over in New Hampshire. I'm happy to talk to folks in Vermont about this issue. I have been working, as Don and Michael know, here in the state of New Hampshire on this issue for several years. Unlike Vermont, New Hampshire doesn't really distinguish between types of businesses. So I'm more familiar with the New Hampshire approach, which is if you're organized to make a profit, you're subject to the business profits tax in New Hampshire. And New Hampshire relies on the business profits tax far more than any other state. 1/3 of New Hampshire's state revenue comes from the BPT. So this issue is even more glaring in the state of New Hampshire, but it's true in Vermont, and it's true in every other state. The fact of the matter is we have an incredibly discriminatory tax scheme in which foreign companies, as Don has very well pointed out, foreign companies can essentially escape with little to no taxation. And whether they're direct competitors with Vermont businesses or not, really doesn't matter. At the end of the day, if I run a business in Vermont and I'm paying corporate tax, I'm paying my full share. And I am, in a sense, in the business world, in that market, I am competing against companies, foreign companies, who aren't playing on the same playing field. They have a head start because they're not subject to the same level of taxation that I am. And that's as Don pointed out, it is erosive, corrosive of people's belief in the tax system and the fairness of it. It is frankly corrosive of any democratic institution. If I feel like, these institutions aren't representing me in a fair way, I am much more likely to look for avenues to evade it as much as possible. And economically, it simply makes no economic sense. It is not congruent with the idea of a free and fair market. It is simply anti-competitive as well as being anti-democratic. One of the things that Don mentioned, the study by the Institute for Taxation and Economic Policy, ITEP, that did a study, I think it was back in 2019, where they estimated that nationally, combined across the United States, this tax avoidance issue, because of Water's Edge, essentially amounted to a loss of potentially $17 billion nationally. And as Don says, the estimate for Vermont was $31 million in that 1 year. What I found, New Hampshire studied this issue with a commission that frankly, whose membership was perhaps not as balanced as it could have been, to put it generously. And I think, the other fact is that I think many businesses based in both New Hampshire and Vermont are not as aware of the discrimination that's happening. For example, New Hampshire in the early 1980s had worldwide combined reporting. And for some reason that I've yet been able to figure out, the administrator of New Hampshire's Department of Revenue Administration chose not to enforce combined reporting on foreign entities. In 1986, thanks to the deal that President Reagan cut with Maggie Thatcher and other foreign entities, foreign governments, the then John Sununu Sr., governor of New Hampshire, helped carry that water. And the states, frankly, were essentially bullied into, they were threatened with, foreign companies are going to move out of your states, all of these other issues. And none of that obviously came true. It really didn't make economic sense for those companies to do it. But the states sort of gave in and adopted this Water's Edge provision, which essentially simply codified the discrimination in New Hampshire, where on the one hand, we weren't enforcing our own law, and then we decided to create a law that said, yeah, we're going to allow discrimination for foreign companies. You'll hear a lot of people talk about, one of the words that I heard a lot in the last year was something called transfer pricing, which is really a euphemism for profit shifting. And I think of it this way, just to get the most basic element. And if I screw up the technical parts of this, Don and Michael will help me here. But imagine you own a company, XYZ Corporation. And XYZ Corporation does a number of things, but one of the things you sell are snowboards, and the other thing you sell are golf carts. Now, chances are in Vermont, you're going to sell fewer golf carts simply because of the seasons, and you're going to sell a lot more snowboards in Vermont than you might say in Mississippi, which has a corporate rate of 4%. Now, if you're a really smart tax accountant working for the XYZ Corporation, you're going to figure out how to shift your profits from Vermont with a higher tax rate to Mississippi with the lower tax rate. That's what domestic combined reporting, which Vermont and New Hampshire have, that's what you prevent, that kind of tax avoidance. The tax avoidance nationally, or internationally rather, because of Water's Edge, says we're not going to look beyond the boundaries of the United States to consider what you might be doing. And so what happens, again, ITEP, the Institute for Taxation and Economic Policy, recently announced a study. This is on their website, so it's very new. In 2020, American corporations claimed profits in 15 low or no tax jurisdictions that were often far too high to even be possible. In just 4 of these jurisdictions, Bermuda, the Cayman Islands, the British Virgin Islands, and Barbados, American corporations claimed profits that dramatically exceeded the jurisdiction's entire economic output. In one case, I think it was Bermuda, the reported profits of U.S. companies that they attributed to Bermuda's jurisdiction was almost $40 billion. And the national GDP of Bermuda was just under 7 billion. So, multiples of, there's no possible way they could have earned those profits. And so what we believe is that, and you'll hear a lot about, well, no other state has done Water's Edge. And, the fact of the matter is that's more about politics than economics. So what we're looking for in the state of New Hampshire, what we're looking for, frankly, in every state, is a level playing field, is fair competition between businesses that are not multinationals, that don't have the ability to use the accounting tricks to shift their profits, and frankly deny the state of Vermont revenue to which it is rightfully owed, or force other Vermont taxpayers to make up that difference. And I'll stop there. I submitted a written statement, and I'm happy to answer any questions. And if they're really technical, you may want to direct them to Don and Michael.
I appreciate you bringing the local business perspective to it, though. Thank you very much. Any questions? Yeah, Representative Taylor.
I could understand the previous testimony about the trademarks but in terms of snowboards, what does that mean if you're going to avoid that by using an offshore company? You actually have the offshore company as the one that's selling the snowboards, or?
Well, the example that I was trying to use was what domestic combined reporting prevents. Okay, so if you have the separate reporting that Don was talking about, where Bob's snowboard business, owned by XYZ Corporation, and Bill's golf carts business, owned by XYZ Corporation, each report separate tax returns. With combined reporting, essentially, you avoid a situation where you reduce the amount of profit to Vermont from the snowboard sales by attributing a lot more of the cost of goods sold, using other accounting techniques to ultimately reduce your profit level and shift that profit to Mississippi by, shifting costs that should be attributable to Mississippi, shifting them to Vermont. Now that would have happened domestically, except that Vermont and New Hampshire, and I think a majority of the other states have adopted combined reporting. If you had worldwide combined reporting, you could do the same thing and prevent companies, whether it's patents or other business deductions, shifting the costs to the U.S. and the profits to these low or no tax jurisdictions, and thus creating this completely ridiculous imbalance where American companies are reporting profits 5, 6, 10 times more than the GDP of the jurisdiction. Does that make sense?
I think so, yeah.
So a company without an international subsidiary is paying their full tax responsibility, and a corporation with an international subsidiary is not paying their full tax responsibility. And so your Vermont-sized corporation that might just be operating in Vermont and say New Hampshire is essentially paying more of their, more than their fair share, or their fair share with a competitor not paying their fair share. So they're at a disadvantage.
The profits of the subsidiary offshore are not being counted in as.
Yes, the competitor is offshoring their profits.
Okay, all right.
Any other questions for witness? Okay.
That's nature.
Great. So I mentioned the MTSS example bill or model bill, sorry, and have some language that Kirby drafted using that model bill language as well as just to like, and that's really just sort of like clean up our statute and make it more in line with other states for now that that model language is available and other states are adapting it. And then also includes moving beyond water's edge to global reporting in the language that Kirby has. I'm not sure how many minutes Kirby has with us because excitingly, the Senate is picking up the municipal flood relief tax abatement bill right now and putting it in all stages of passage. So we'll have that next week, but that means that Kirby has to be in two places at once. And so do you want to give it a try or would you rather we reschedule? Okay, great. Okay. So I think what we're going to do is, sorry, one second. We're going to do a quick run through so everyone gets a high level view of the language in this bill. Folks can read the bill themselves in their own time, and then we'll have Kirby back next week to do sort of questions on the language of the bill, as well as next week, Pat can share with us some money, some dollars, and not money, but dollars related to the new legislative language. Yes, Representative Taylor.
I just wanted to, the other thing I was curious about was the mention of enforcement.
Yes,
And somewhere along the line, maybe I have questions about how this would be enforced.
that's a good question. Congratulations on sharing your screen again.
Just getting lucky, I guess. Kirby Keaton, Legislative Council. So as Chair Kornheiser just mentioned, I have to run off to the Senate very soon just to make sure that they're supported over there on the floor for the flood abatement bill. But I can tell you what this language has. It's 16 pages, but most of it is, as Chair Kornheiser mentioned, is the bill incorporates the Multi-State Tax Commission's model language on combined reporting using the Finnegan method, which is exactly the same as Vermont, except that that model language also had a water's edge election. And that election has been removed for this language, which means it would effectively make Vermont a worldwide combined reporting state, mandatory. The other changes in the bill really are about we would remove from taxable income the types of foreign income that's already taxed that flows through from the federal return, because the water or the worldwide combined reporting would get that anyway, so that it wouldn't be double counted. And then there's also an intent section that's added. And if you'd like, I can very quickly. So the
A little bigger. Do you know how to do that?
Thank you.
I find that just using the plus sign works
Control
sometimes.
plus, Mike.
Okay.
The full screen, full page.
There's not a menu here that is working.
Yeah, but
We're good. Well,
sorry. Well, yeah, I won't have time to show you all the details anyway. But there's some intent language that's added to the subchapter on corporate income tax that just specifies that the intent of the General Assembly is to have the corporate income tax statutes interpreted using unitary business principles, which is what we've been talking about this whole time about the concept of unitary groups and how a group of corporations should be treated as one company. That's just a precautionary thing to add. A lot of the MTC language is just putting what Vermont already has in regulations into statute. So there's not a lot of substantive changes. The big intended change here is the move to worldwide combined reporting. Everything else is just adding a lot of details into statute that currently Vermont is relying on regulations for. And this language would also add a lot of support to the regulations we do have, because right now our statute is pretty limited on details, which maybe makes our regulations possibly vulnerable to be challenged because there's not a lot of statute to back them up.
and the way I think about this, and like, please correct me if I'm wrong, is we've spent a lot of time talking about sort of towns' ability to defend their appraisals, for instance, right? And the state needs to back that up. And I just want to make sure that essentially like Vermont's tax department is able to defend themselves and do everything we can in statute to make sure that's possible. Because corporations, just have bigger pockets for lawsuits.
Yes, so hopefully the MTC language would help with that. But again, there's a lot of language here that's just doing the same thing Vermont's doing. But just adding a little detail to the law to make it survive a lawsuit better. And with that, I could take off unless there's questions.
No, that's great. That's great for the big picture. Thanks. And we'll have you in next week to talk through it. Pat, is there anything you want to add, or should we just cover it next week?
Rest assured that your jail phone is hard at work on an estimate. I'll have some preliminary for you next week, and I think you're still after that, I'll have something by.
Thank you very much. So we are going to wrap for the day and the week, everyone. And excited about the Senate and the tax abatement bill, excited to dive deeper on this bill, and we will